So welcome back to exercise 5-7. If you manage to locate the proper expense accounts from the trial balance that was provided, you should have gotten this closing entry to close the expenses. Would have started with a debit of $65,400 to income summary, and that 65,400 is the total of the three expense accounts that are in the list. Now I will tell you a little trick. The closing entry for expenses always starts off with a debit to income summary, but we often don't know what the amount is. The trick I use is to write income summary in there and just leave it blank initially, then list out all the expense accounts and the credit for each entry, and then once you get that total, write that total in as the debit to income summary. And of course you're welcome to use that trick. So the description, of course, is to close or zero out the expense accounts. Now the next closing entry is closing out the income summary account, and the income summary account is incredibly temporary. It exists only for this purpose. And what I've done is I'm going to represent that with a T account. I've gone ahead and drawn up here. This is the T account for income summary up to this point. This 62,450 was the entry that came from closing the revenue accounts. This debit of $65,400 is the closing of the expense accounts, and it came from those two journal entries here and here. So the balance in income summary at this point is $2,950 debit, and we want to close or zero that amount out. So we need to, in order to close this out or zero it, it currently has a debit balance of $2,950, being the difference between the debits and the credits, and we have more debits than credits, so the balance is a debit. This actually tells me something a little unusual, because normally we would expect the balance in the income summary account to be the credit side, and the reason that we would normally expect that is this number represents the total revenues for the business. This represents the total expenses for the business, and normally we would expect the revenues to be higher than the expenses and we would get a net income. In this question, they actually ended up with a net loss. Their expenses were higher than their revenues, or greater than. But be that as it may, we need to zero that account out, and so we're going to have to put in a credit of $2,950 to zero this account out. So let me just start writing up that journal entry. It's still January the 31st. And we know we're going to have a credit to income summary. The question is, what do we debit? Well, when we're closing the income summary, zeroing that account out, what we're doing is we're transferring the income or the loss for the period to the owner, because remember, the owner is responsible for, or either gets the income or is responsible for the loss. And so the other account we're going to use here is the owner's capital account, and that will be, in this case, will be a debit to owner's capital. And the owner of this business, if we double check the question, is Kate Goldberg. We see Kate Goldberg Capital. So we will debit Kate Goldberg Capital, and credit income summary for the amount of the income summary. So we're going to debit Kate for $2,950 and credit income summary for $2,950. Now, the result of that, of course, will be, when we put that through, will be to zero out the income summary account, and Kate's capital account is actually going to be decreased by $2,950. And the journal entry requires a description, so to close income summary. The last closing entry, of course, will be for drawings or withdrawals, also dated January the 31st. And drawings or withdrawals normally has a debit balance, so we're going to credit the drawings account. So it'll be Kate Goldberg drawings for the amount of those drawings, and just double check here. the Kate Goldberg withdrawals account, $4,000. So we're going to debit that or credit that for $4,000 and debit Kate Goldberg capital for the $4,000, and that's to close drawings for withdrawals for the period. And what that does is it zeroes out that account, the withdrawals account, so we can keep track of how much Kate takes out in the next accounting period. And so those are the four closing entries. Ultimately, what will happen is the capital account will be credited or debited for whatever the income or loss of the business is, and also then reduced by the amount of money that the owner has actually taken out of the business, in this case $4,000, and we'd end up with the ending capital balance. It will be very reflective of what we would expect to see on the statement of changes of owner's equity. Anyway, if you're comfortable with that, you can give exercise 5-8 a try. It's very, very similar and follows the same kind of pattern and would be excellent practice. Good luck.